Hi, good morning, everyone. This is Paul here. We'll just start off with our Singapore weekly update. Um, as you can see, we have no change in our target price. It's 3270. In terms of the update on the macro backdrop, the most notable event last week was the ECB meeting. Everyone was wondering whether they would mention something about tapering their QE. But they've pushed this QE tapering decision to probably likely to September. And any expectations, there are expectations in the marketplace that probably the tapering from the current 60 billion could happen in January of 2018. The other notable macro news was the China's GDP. Again, the numbers were slightly above expectations, and it was driven by the strong property sales that we've seen in China and also fixed asset investments. Locally in Singapore, the more notable macro data point was exports rebounded strongly in June. As you can see, exports in June was up 8%, whereas it was a flat in May. There was also the advanced flash GDP at 2.5. With this export number, there is probably some upside to the GDP numbers in Singapore compared to the flash numbers. In terms of our strategy, it remains the same. It's buy a sustainable yield, and for momentum, it's property. Our yield stocks, as you can see, no change. We included Ascendas REIT, which is our recent initiation. In terms of property, it's CapitaLand, Belong, and so forth. And our other stock picks will be Thai Beverage and our new initiation, which is Sing Investment and Finance. In terms of corporate updates, I'll just give a quick summary, as more details will be mentioned later. On CapitaLand Commercial Trust, we've upgraded it to accumulate. After 8 quarters of decline in office rents, we've finally seen some pickup quarter on quarter. The other reason for our upgrade is that we've also seen some cap rate compression. Basically, valuations for office property recovering. We've seen this first uptick since 2012. Another company update will be Capital Mall Trust. The rental reversion, we are still negative on CMT because the rental reversions continue to spiral down. On Capital DC REIT, again, the valuations are high, but we just need acquisitions to justify this. And on SETS too, we find that the valuations are high and also growth is modest. And also we expect some pressure on SETS earnings with the current SIA restructuring. As you recall, in May, SIA announced a restructuring program whereby there will be cuts in their costs, and they need to transform themselves. Thank you. I'll move on to Jeremy on his initiation.
Hello, good morning. Okay, so we have initiated on the Sing Investments and Finance Limited. So the main title here is a massive 40% PATMI growth in FY17. So this is on the back of some of the tangible industrial developments, in the sense that the rising interest rates and also some of the regulatory changes to the finance industry, which will help catalyze this growth in profit. So just a snapshot. The previous close is at 1.475. Our target price is 167, and the forecasted our forecast dividend is 7.9 cents, which will translate at the current prices about 5.35%. So here are the key points to why Sing Investments we have given an accumulate rating. So the tailwind would be the rising interest rates and the regulatory changes to the finance business, and in that aspect, the regulatory changes that will have a near-term impact to it will be the ability to offer checking and current account services. So this will actually help bring down the deposit costs for the credit finance companies, and therefore the expansion of NIMs will be driven largely by the favorable rates going forward. So this would actually help catalyze the 40% increase in income for SIF, as the rising rates will show that they have a better upward volatility to rising rates, which they can have a better pass through of these rates to customer loans. And the second part to the regulation changes would be the ability to go into uncollateralized loans business. This will help them penetrate deeper into the SME clientele. And the third would be we have written some of the developments that have occurred in the Southeast Asia e-commerce scene. So this is something which investors can read further in detail to look at how this could help the credit finance companies. So lastly, what will support this increase in earnings will be the operating efficiency that will help drive this performance. So as we can see from the SIF's loan products and credit facilities, most of the, in fact all of it here is still under the collateralized loan segment. So as for SIF, they have not moved into the uncollateralized business yet. So this year will be an interesting year for them with the changes to regulation. So this is one area which we will see how they will be able to extend and move and penetrate into that area of business. And here's the breakdown. As you can see here that the higher chase is where the auto segments are. SIF is actually a major player in the auto loan segment, so this is where the bulk of it is here. And the business for SIF is very straightforward. They generate 88% of their net interest income from customer loans. So they do not deal with other instruments such as, or other products such as foreign exchange, or they do deal with commodities. So their business is very straightforward. So okay, the first part of our investment thesis is that as interest rates is rising, you see that they have a greater potential to expand their net interest margins. So based on the profile, the yields on loans on the profile of the credit finance companies, you can see that the volatility is a lot greater than the banks. So as interest rates are declining, they would decline faster. And conversely, if interest rates are rising, they would also increase. They would also move up faster. And we attribute this to the fact that their clientele, which is the low middle market clients, which we define here as 5 million to 100 million revenue companies, they are more sensitive to the economy and to the interest rate environment. And we also believe that in this cycle, as interest rates are rising, they will also experience a better pass-through of the higher rates to the low and middle market clients. So here's also the profile of the cost of deposits for the finance companies in Singapore. You can see that the upward volatility is extremely steep. But again, we'll say that because of the ability to offer current account services and checking services, we expect this upward volatility to be less steep. So with less steep rise in the cost of deposits, while a better increase in yields for loans, that's where we will see the expansion of net interest margins. And so second part is when we talk about competition for the low middle market loans. So we believe that the banks will not compete intensely with the credit finance companies for this segment. It's because the banks are now coming out from, or are still dealing with some of the oil and gas exposures, which actually cast some doubt over the quality of those assets that they have currently. So they will be extremely careful over the exposures to higher risk loans, and the banks will definitely be prioritizing higher quality collateralized loans over the uncollateralized. So in that sense, we believe that the banks will not actively move into the space of the credit finance companies, especially for the area of uncollateralized loans. Second is that the client to relationship manager ratio is lower at the credit finance companies compared to the banks, and this gives the credit finance companies a more intimate relationship with the clients. And we will see that this closer relationship will, in a way, lessen the competition from the banks as to how much attention they could pay to this SME clients. And thirdly is actually the credit finance companies offer a private banking experience for SMEs. And when we talk about the private banking experience, we are talking about the business and personal needs of the SME owners. So in the credit finance companies, they endeavor to address the business and personal needs in this, based on a single profile. So there's no need to go through multiple channels to achieve some of the objectives. So what the banks are doing today to create this seamless experience will be in the private banking platform, which is actually the upmarket platform. And in order to enjoy that, you will have to qualify as a private banking. So that is actually a hurdle to cross. So we see that the credit finance companies will have a niche if they continue to be effective in how they address this market. So third part of the investment thesis will be the partnering with the e-commerce operators, but I shall not dwell too much on this because this is actually a future roadmap. In the report, you can see some of the attachments and descriptions on how this area will flow through into will have that potential to help grow the uncollateralized loans to the credit finance companies. And the loans origination growth potential for Southeast Asia, which is also further elaborated in the report, so you could take a look at that. And of course, finally, the government initiatives to help e-commerce players. So this helps connect the dots to create a holistic ecosystem for the credit finance companies. Okay, so now to the company's specific investment merits. So the regulatory changes to could catalyze a meaningful increase in SIF's net profit. So this is following up from basically the ease of regulation of uncollateralized business loans exposure. So the limit to uncollateralized loan business is raised from 10% to 25% of capital funds. So this could mean that they could go up to 80 million now of uncollateralized loans exposure. But as you can see that the loan size is not a significant portion to the total loans books. It's still the SIF's loan books is just slightly above $1 billion. But the impact would be better on the net profit line because the margins on this higher risk uncollateralized loans will be a lot higher. So we estimate that it could add, all things being equal, it could add about 4.7% to SIF's full year 2016 net interest income of 38.6 billion. So this is an avenue which we believe they could capitalize on depending on their sales channels and how they will be able to drive this strategies moving into this year. So the knock-on effects on that would be the finance companies can start building the relationship with SMEs at a very early stage, and this gives them expands the opportunities to extend collateralized loans later on as the SMEs start to develop. So the expansion of the net interest, the few benefits, the few reasons to drive the net interest, the net profit will be the higher NIMs, which the higher NIMs will be rates driven rather than loans growth, and also the normalization of bad loans provisioning. And when you speak of the normalization of bad loans provisioning, let's look back at the profile of the NPL and loans yield and the bad loans coverage ratio as we see here. They have the SIF has been passing through higher rates since 2015 and 16, as we can see here. At the same time, the NPL, the non-performing loans profile has actually come down from the 2015 high. So you can see that actually SIF is managing this higher rates versus its exposure. In a way, you can say it's the risk-reward profile is very optimal. And at the same time, the bad loans coverage ratio has, as of 2016, is at a high level of 170%. So barring any economic volatility, we believe that given the profile in FY16, moving FY17 will look a lot more positive. So we will expect the provision expense to be minimal, and this will help drive the PATMI growth. So all in all, our expectation for ROE will be close to 5.5%, and net interest margins would expand to close to 1.7% from 1.5%. So with this surge in earnings, expected surge in earnings this in FY17, we believe that there's a potential to increase the dividends per share from 5 cents to 7.9 cents if the payout ratio is maintained at about 63%. So 63% payout ratio is not unreasonable, given its historically it has moved beyond 60% before. And even with the increased dividend payout, we will still expect the capital adequacy ratio to maintain above the required 12%. So the next thing to the investment merits will be the strong financials. So it's a very clean balance sheet. Yes, no debt except for a small amount of liabilities. Then there's a good headroom to expand its loan-to-deposit ratio to boost its net interest income. As you can see in the graph here, its loan-to-deposit ratio has declined steadily, and where we mean expanding the LDR, we say is that as the rates are rates are rising, the SIF will have more headroom to cut high-cost deposits faster than if loans growth were to be weaker. So as you cut more of the high-cost deposits, the loan-to-LDR ratio will actually expand. So it gives it more room to expand from close to 82% to upwards to about 88 to 90%. And this would actually significantly boost the interest income. And SIF has also the best operating efficiency, and so as you can see here that since 2013 it has been managing its cost-to-income ratio steadily downwards, and as of FY16 it's yes the best cost-to-income ratio as compared to the banks and its peers in the finance industry. Finally, it has the most efficient deposit management amongst its peers as well. So the deposits per branch is the highest amongst compared to Hong Kong and Singapore. Next, to investment risk, the credit risk that we will highlight for this year will be that we are more concerned of is if the non-performing loans profile were to accelerate faster than the pass-through of higher rates. So that is a risk that will be the main theme this year. So that is where the SI will have to be very careful and to monitor the exposure to their clients quite closely. The rest is liquidity risk. But we feel that given the efficient deposit franchise, we believe this risk is actually not at the top of our list. And the last one will be market risk. But because SIF is not, they are not allowed to deal with other asset classes like commodities and foreign exchange products. So in a way, owing to this regulation, those exposures are not there, so it really minimizes its market risk. So next is our forecast assumptions, and the loans growth we expect to be flat in FY17, as I mentioned earlier, that the income will be driven largely by the rates rather than loans. So, and then our next assumption is cost to income ratio improves to about 48%, and this also because of the income driven largely by rates rather than volume. So, with volume not being the main driver, we will expect the sales cost to be the sales cost will be managed lower as a percentage to revenue. And our forecast does not include the loans volume growth from the e-commerce opportunities. And for valuation, we use the price to book versus ROE dispersion chart because we believe our view is that the banks and finance companies will trade at the book value ratio that is positively correlated to their ROE. So as you can see, the banks have ROE close to 10% and therefore they are traded at a premium to book value, whilst the credit finance companies, their ROE is lower end of the curve, and so they are traded at a discount to book. But considering SIF's ROE profile, which is the highest amongst the three, we feel that the current price to book value is actually conservatively priced. So we believe it should go up closer to in line with the curve, and therefore we believe it should move closer to 0.8 price to book. And at 0.8 price to book, the target price would be $1.67. And we use the valuation model to ascertain whether this is a reasonable price. So based on valuation, the target price is $2.34, which is above the target price that we give. So we believe that 167 is a very reasonable target price. This is the 3-year historical price to book ratio. And here's the 1-year historical performance relative to SCI. And here's the peer comparison. As you can see that Sing Investments and Finance is has a high dividend yield of 3.4%. And hopefully that this yield would go higher with the increase in dividend per share. And this is the SWOT analysis. So since I've spoken about the strengths and the opportunities, I'll just highlight a little bit on the weaknesses. So the finance business in Singapore is still a very regulated one. So some things such as new branch opening and expanding to overseas markets is something which is subjected to approval. And they are also currently still not allowed to deal with other asset classes such as the commodities and foreign exchange. Sing Investment and Finance market is currently still entirely in Singapore, so it has a concentration risk. And its performance is sensitive to the domestic economic cycle. So our accumulate call here is predicated on the fact that we could see the economy improving, And with that improvement, we can the pass-through of higher rates is better accepted by the SMEs. So this is our base case. Lastly, the weakness will be the volatile non-performing loans, and this will may come as a downside surprise. The other threats will be the rise of multiple alternative lenders, but we believe that this market is still small. Second would be the major e-commerce platforms will decide to create their own financing vehicles, but we think that based on the historical, or I would say the recent history of how they have been conducting themselves with, in the area of logistics and e-payments, we think that they would seek out partnership more than creating their own vehicle. And the third threat would be from banks if they can find a way to productively engage the low and middle market clientele. That will pose a major threat to the credit finance companies. And in the appendix, we give a summary of the changes to the finance company regulation before and after for your reference. Okay, that ends my presentation. So next we have Teng Hong to present on the CapitaLand Commercial Trust earnings.
Hi, good morning everyone. Teng Hong here. So we had a few REITs reporting last week. I'll go on to touch on. There's somebody asking for the last slide for Sing Investments. I think we will go through the results first, and then I'll go back to Sing Investments. So, as mentioned, I will touch on 3 of the results for last week before I pass on to Richard. First one I'll do is CapitaLand Commercial Trust, and this is one which we upgraded last week. We had a neutral call before last week. Now we're upgrading it to accumulate, and there are three key reasons why we're upgrading it. I'll touch on them later. For now, I'll brief you on what happened in the results first. So we saw that gross revenue went up, but this is primarily pretty much expected because they took over Capital Green. Ownership went up from 40% to 100%. So that increase in ownership bumped up revenue by 30%. So net property income went up accordingly, but you see that it's gone up more than what gross revenue has gone up, primarily because property expenses from Capital Green was higher, but it's offset by lower property tax. So as mentioned, we upgraded CCT, and the first reason is that from what we saw, generally the grade A office rents, we're seeing signs of stabilization after 8 quarters of Q-on-Q declines since the peak in 1Q15. Finally, this quarter in 2Q17, we are seeing signs of stabilization. Grade A office rents came in about 895 in the last quarter. And then secondly, we saw that across the board in CCT's portfolio, there was cap rate compressions. And on top of the paper gain, the unrealized valuation surplus in the books, CCT also divested 3 properties and at cap rates which were lower than what was previously recorded on the books. So that 3 divestments actually boosted NAV. Total divestment gains for that 3 properties was about 170 million, and that translated to a 6 cents boost in NAV. And as I have mentioned, the compression in the cap rate and the discount rates, and this is the first compression since 2012. This compression actually increased portfolio valuation by close to 3% since 6 months ago in December. So the third reason is that we're actually forecasting a cash top-up from all these divestment gains. So we're forecasting that management will use the cash to top up the loss, to top up DPU, which will arise as a result of the loss of income after you have sold the 3 properties. So we are forecasting a cash top-up for FY17 and 18 to maintain DPU, and which is why we've adjusted upwards our FY17 and 18 DPU by 5 to 10%. So our final rating now is an accumulate higher target price of 180, and that translates to an FY17 yield of 5.1% and a price to book of 0.93. So the next one I'll touch on is CMT. CMT operating environment is still challenging. Gross revenue went down slightly, down 1.3%. This is also expected because Funan, as we all know, is closed now for redevelopment. So loss of income from that building caused revenue to drop marginally by 1%. And then, but MPI still managed to maintain stagnant because property expenses were lower, and they were lower because of lower utilities and lower maintenance fees. So what we saw in the quarter for CMT is that the rental reversions were still weak. This is mainly driven by weakness in Bedok Mall and Westgate. These are two malls which opened at the end of 2013 at the start of 2014. So they are going through the first renewal cycles. So a bit of weakness in that two malls driving the whole overall portfolio negative rental reversions. But generally, we see that some of the bigger malls like Tampines Mall, Junction 8, they're also seeing rental reversions weakening. So generally as a portfolio, in 2015, we were doing close to 5%. Right now, we're doing a negative 1.6%. Okay, on the tenant sales front, on the consumption patterns front, we see that in 2Q17, it was actually more steady, more stable than in 1Q. It's improved, but generally it's still kind of like quite pretty slow, even though there was an improvement. So the improvement was driven mainly by new tenants and promotions in sectors, in some of the peripheral sectors such as the music, the electronics, the entertainment sectors. And you see that the main anchor segments like F&B, your supermarkets, which are the traditional crowd pullers, they remain weak. So this is consistent with the trend seen in 1Q17 as well. And similar to CCT, we saw cap rate compressions across the board, 50 basis points on average, and this boosted portfolio valuations by about 2% from 6 months ago. So for CMT, we still maintain a neutral target price is 201, and this translates to a yield of 5.6% and a flat price to NAV. Okay, third one will be First REIT. For First REIT, there were two events that occurred last week. Earlier part of the week, they had their results, and then on Thursday night, they did their first acquisition for the year, and this acquisition is from their sponsor. What we saw was that the base rental yield on the cost that they're acquiring is a pretty comfortable 10%. Okay, first on the results, this is top line grew 3%, and this is as a result of the new acquisition. If you consider organic growth just from existing portfolio, variable rents grew 1%, because we all know that last year the base rents are all pegged to Singapore CPI, and last year Singapore CPI was negative. So base rents, there was no movement, but variable rents went up 1%. And for the quarter, there was lower finance costs, and this was because they issued perps last year, and they used the perps to pare down the debt. And for this year, they're going to have 34% of debt expiring. This may be a concern for some investors because the Fed is hiking interest rates, and then we will all be concerned about how much of a finance cost will go up for First REIT. For them, management guidance is that the interest costs for this tranche of debt that's supposed to expire is likely to remain stable, and bank offerings remain competitive based on initial quotes that they're getting for this tranche of debt that they're refinancing. And we are assuming that they are sticking on to the same kind of loans, that is the secured loans that they have been traditionally getting. So a bit more about the acquisitions they did last Friday. This is from their sponsor, and yield on cost is about 10%. Is pretty much consistent with previous acquisitions. They've traditionally done about 9 to 10% yield on cost for the previous acquisitions from the sponsors. Expectation for funding for this acquisition is that they will use debt and internal cash. So this 10% yield on cost is a comfortable spread over the average cost of debt we saw for First Street in the last quarter, 4.1%. And even if you assume a 40-60 debt equity kind of financing, we arrive at an average cost of capital of 5.1%. So even at 5.1%, you still get a 4.9% spread from your rental yield. So this is an accretive acquisition, and it highlights the continued support from the sponsor. We maintain our neutral call on this REIT, and our target price is unchanged at FY17 yield of 6.5% and a price to book of 1.22. So, okay, I'll pass on to Richard for the rest of the results.
Thank you, Teh Hong. Okay, so now we carry on with REITs in the industrial space. Keppel DC REIT also announced their results last week. We are maintaining neutral. Target price slightly higher, 128. Our forecasted DPU is 6.84 cents for this year, and that translates to a 5.4% yield over the last close price on Friday. So you can see here there was a strong revenue growth. This is mainly from the contribution of Keppel DC Singapore 3, where they acquired 90% of it last year. They also acquired some data centers in Europe last year, so this contributed to the strong top line growth. Property expenses increased 14% year on year, and so revenue growth actually outpaced this increase in property expenses. So we still see quite strong net property income growth, and this also translated to distributor income. However, on the DPU level, it's 4.2% higher year on year. This is the effect of the preferential offering that was done recently to fund the acquisition of the new data centers. Operationally, quarter on quarter, the WALE has been extended, but occupancy is lower. This is mainly from the data center in Malaysia, Basis Bay. The tenant there renewed the lease for 5 years, so that's the explanation for the longer WALE. But the data center has got 3 floors, and the tenant only renewed for 2, so 1 remains vacant. So that is the reason for the lower occupancy quarter on quarter. The manager is already starting to market the remaining space in that data center. Something positive is aggregate leverage is among the lowest among the S-REITs, 27.7%. So this gives them a estimated debt headroom of 300 million if you assume a 40% leverage, and this could potentially grow the portfolio by 20%. One of the laggard in the portfolio is Keppel DC Dublin 1. So last year, one of the tenants downsized there, and it still remains underutilized, hovering at the 50s level for occupancy. One of the issues with this property is that the power supply there needs to be upgraded in order to attract prospective tenants. So the upgrading will be carried out starting the end of this year and should be finished latest by the early part of next year. So this we think that this property would still be underutilized for the remainder of the year and would only see some take up later part of this year or some commitment. Overall, there's a stable outlook for the REIT in terms of expiries, lease expiry profile and the WALE. They have two major leases which expire this year, and the manager already has in principle agreement on these two leases with the tenant for renewal. Next, we move on to Cash Logistics Trust. The revenue was lower year on. The key change for this is we've upgraded it from neutral to reduced. Target price also higher, 86 cents. Forecasted DPU is 7.03 cents, which offers a 7.5% yield over the last close price of 94 cents on Friday. Revenue was lower year on year, mainly from divestment of Cash Changi District Center 3 and the issue that's going on with 51 Alps Avenue. This property was formerly known as a Schenker Mega Hub. This lower revenue was offset by the contribution from the DSC ARC and the Australian properties. Note that with the divestment of this Cash Changi District Center 3, the manager acquired this property in Australia called Spotlight. So with the lower gross revenue, this also translated to lower net property income and lower distributable income. At a net property income level, expenses were higher due to conversion from master lease to multi-tenancy for the high-speed logistics hub. This was in the fourth quarter of last year. Year-on-year DPU is down 9.5%. So in this year, 2Q 2016, that 199 was without any top-up from capital distribution. So this year, the 2Q 17, the 1.8 cents DPU actually includes a 0.013 cent top-up, which is from the proceeds of divestment from the Kim Heng warehouse. Operationally, quarter-on-quarter, occupancy is higher from 97.2 to 98.3%. This was from new leases signed at these properties. So new leases means new tenants. So this is not renewals but new leases. One of the negatives is that there was negative rent reversions during the quarter. They had one outlier renewal that was as bad as minus 20% reversion. So earlier we talked about the year-on-year DPU. So, but on a quarter-on-quarter basis, it remains flat at 1.8 cents. So the manager has used top-ups in both first quarter of this year and second quarter of this year to stabilize the distribution. On an underlying basis, if you exclude the top-ups, DPU actually has grown 5.3% quarter-on-quarter. So we're seeing some improvements operationally for them, and this comes from the rebalancing of the portfolio into Australia. So overall, we have a stable to negative outlook. As mentioned, Australia, there's a strategy of rebalancing, and that has stabilized the quarter-on-quarter DPU. However, on the Singapore side, oversupply of warehouse space still persists. This year, though, they do not see much risk in terms of renewal because only 1.8% of the net lettable area is expiring in the second half of this year. One of the biggest risks they face is next year, where this master lease for CWT Commodity Hub will expire in April 2018, and this accounts for about 12% of their portfolio NLA. Moving on away from REITs and into aviation, we have SATS. We have maintained neutral, target price unchanged from the last quarter, unchanged at $5.08. We still forecast a dividend of 17 cents unchanged, and this offers a 3.3% yield over last Friday's close of $5.08. So revenue was marginally higher by 0.5%. I'll go into more details between the gateway services and food solutions revenue contribution further down. Operating profit down 1.8%. There was a high expenditure, mainly from the cessation of rebates at Changi Airport. So this resulted in a lower margin of 12.5% to from 12.8%. Other expenses also was coming from depreciation as well. So if you recall, SATS is going through some transformation in the way they structure their business. They are trying to invest more in technology, automation, and machines in order to improve productivity. So there's a trend of higher operating leverage for the company, and they're trying to move away from variable costs such as staff costs. So operating leverage for the group is actually increasing, and this is one of the factors that's having the lower margin at this point in time. And other things that they're investing in is doing M&A to get expand their footprint through associates and JVs. So you can see that associates and JV this quarter, they had a really robust growth, 27%, and this is higher contribution from both the food solutions and gateway services JVs. Lastly, PATMI, the headline PATMI is lower 10.6% year on year, but that's because last year there was a last year in first quarter of FY17 there was some one-offs of asset disposal and a loss on divestment in an associate. So if you take out these one-offs, actually the underlying PATMI has grown 3.2% year on year, and also you can see that the net margin has improved from 13.1% to 13.4%. So net margin improvement actually comes about mainly from the contribution of the associates and JVs. So that's when the you can see that although revenue was flat, but associates and JV line is contributing a fairly more to the bottom line. That's where the growth is coming from for SATS. So I'll move on to talk a bit more about where their revenue numbers are. So for gateway services, revenue was up 5.6%. This was driven from the higher cargo volumes, higher number of flights and passengers handled. For the food solutions revenue, there was a negative surprise from TFK Corp. This is their catering subsidiary based in Japan. So there was the revenue from TFK Corp was 11% lower year on year. The reason for this was weaker meal volumes as two of their customers, Delta Airlines and Japan Airlines, had cut their flights. So there's no visibility on this front in terms of when the flights will be reinstated. So this is one of the negative surprise, and you will recall that actually it was TFK actually did have a positive surprise last year when the volumes picked up, and also they had some boost when they managed to sign this multi-year contract with Delta Airlines. The other aspect of food solutions revenue comes from the non-aviation food in Singapore. So that was lower. SATS says that it's in relation to one of their major contracts, but they expect this effect to be temporary, and volume for this contract they believe that it should go up again, normalizing forward. So next bullet point is on the associates and JVs. So I mentioned earlier the higher contribution from associates and JVs has managed to shore up the bottom line and has kept the PATMI growth in a positive territory. I've talked about this just now, the higher OPEX from the higher license fee. This is arises from Changi Airport. So Changi Airport Group has ceased giving them these fee rebates on the license. So that contributes some of the chunk of the higher expenditure year on year. For outlook, we have a stable to positive outlook for SATS. The key theme of air travel growth and demand for safe food remains intact. However, in the near term, there will be some pricing pressure as the airlines are facing low yields. But this is there could be some silver lining in this, in that when the airlines are facing their low yields and they try to restructure, they may divest some of their non-core businesses such as ground handling and catering, and this could present opportunities for SATS to acquire these adjacent businesses and augment their network. Don't forget that SATS actually has a strong balance sheet, is in a net cash position, so it does have the firepower to do these acquisitions and expand their network. Okay, we have come to the end of the presentation. We'll pause now for questions. All right. Today questions a bit dry, so there are no questions. We'll end the webinar here. Tune in next week for our next webinar. Thank you.